The market has settled down and squared up positions into the always highly anticipated FOMC decision event risk. Heading into the decision, the overwhelming consensus expectation is that the Fed will leave rates unchanged with 0% chance for a rate cut and an actually very small 13% chance for a rate hike. There has been reason for the Fed to be feeling better about the Phase 1 trade deal with China, and this would account for those rate hike calls. As far as the coronavirus goes, there is no evidence that would suggest the outbreak should go as far as factoring into Fed policy, with a more reasonable expectation that it will simply be monitored. President Trump has continued with his campaign against the Fed, most recently calling out the central bank in Davos, saying the Fed should get smart and lower the rate to make our interest rates competitive with other countries which pay much lower, even though we are by far the high standard. But the Fed won't be looking to acknowledge that it is playing into the president's demands, and we won't be expecting any accommodative gestures on account of the president's efforts. It's worth noting there will be no new economic projections today, though we will get a presser from Jerome Powell. As we look out at Fed pricing, the market is looking for a 33% chance of another rate cut between now and June, and the tone of the monetary policy statement and Powell presser could very well inspire the bulk of today's volatility around the event as traders look to adjust Fed pricing accordingly. Bottom line today, if the market perceives the Fed leaning more to the overly cautious and accommodative side of policy, expect the US dollar to be at risk of selling off on the yield differential implication and stocks to feel good about the central bank's ongoing commitment to prop up the market. On the other hand, if the Fed comes off more upbeat, the US dollar could be in for another run, while stocks would be exposed to downside pressure as investors get to thinking about the end of an era of unprecedented policy accommodation and stock market valuations that are no longer as attractive as they once were as a consequence. That's all for now.